Thanks for joining us. One of the things that you can say with great certainty is that the future is always uncertain and no truer than today. Despite that, there's actually some good news in the world economy with some green shoots economically coming through. Joining us today is Hamish Douglass, the Chief Executive Officer of Magellan Financial Group, to talk about his views of the world economy. Thanks for joining us, Hamish.
A pleasure, Mark.
Hamish, the shenanigans in US politics at the moment, that's been well documented, does that make you nervous as an investor?
At the end of the day, it doesn't make me very nervous. At the end of the day, you have to appreciate that it is incredibly unlikely that the US wouldn't ultimately raise the debt ceiling, which is the big issue. We've got the budget funding, and we're always going to have games around the budget funding in the United States, but the big issue is not raising the debt ceiling, which is the theoretical thermonuclear option of the US defaulting on its obligations. As Warren Buffett said in the last 24 hours, he said this is political weapons of mass destruction. And at the end of the day, the US is incredibly unlikely to pull that trigger. And if they pulled the trigger, would I be nervous as an investor? I would be terrified as an investor if they pulled that trigger. But as investors, you're here to think logically and objectively of what the probabilities of what will happen. And the probabilities of the United States using a political weapon of mass destruction, which could have devastating consequences on the United States and the rest of the world, because of course the world uses US treasuries to effectively fund itself in collateral around the world, and if that collateral defaulted, the whole financial system in the world would be in deep, deep trouble. And I just think it's very unlikely that the US is ultimately going to go down that track. I think we've seen the theatrics of that recently, and we'll see it again in another 6 months' time. We'll probably see the theatrics of it again. But as an investor, am I nervous about the theatrics of Washington that's going to cause a cataclysmic event in the world? No, I'm not nervous about that. I think the probabilities of that is very, very remote indeed, and therefore we don't get caught up in that short-term noise. Do I think there are any implications of what's going on in Washington? Yes, I think we're going to have further budgetary pressure. That's probably going to slow down the natural rate of recovery in the United States. We're still very optimistic on the United States recovery over the next 2 to 3 years. But the pressure in Washington is probably going to put further budgetary cuts as outcomes to negotiate their way through these budget ceilings. And
you've spoken a lot about the US Federal Reserve Quant Easing program and how that's playing out. Is that proceeding as you've expected?
Yes, QE is so far playing out as we expect. We're really expecting sometime maybe later this year for the Federal Reserve to slow down its purchases. Bernanke put that on pause recently. We think Bernanke put that on pause is he just wanted some of these games in Washington to be played out before he actually was going to embark in tapering, slowing down the $85 billion a month of purchasing. Tapering doesn't mean ending. Ultimately, as the US economy recovers, they're going to have to stop the purchases of mortgage-backed securities and government bonds, and we're going to see rising bond yields. Our central thesis is still to get maybe 4 to 5% long-term interest rates, long-term bond rates in the United States, and quite a bit of volatility, and that's really going to play out next year. There is still a risk that if the bond markets lose confidence in the Federal Reserve's ability to exit their excess reserves, we could see a major bond market crash, which would mean bond rates for a period materially above that 4 to 5 sort of levelling out level that we see in the future. We still put a low probability on that. It's not a zero probability. So really what I wrote about at the end of our last financial year around how we see this exit, I think that is really playing out, and once we're through this Washington debate, I very much expect the topic of the markets is all going to be about Fed tapering again and the exit of QE.
Hamish, the Magellan Global Fund has actually underperformed the market in the last 3 months to September, which personally doesn't bother me because it shot the lights out over the previous 5 years. But have you got any comment on that?
Well, I'd make a few comments on that. We don't pay much attention to benchmarks per se over very long periods of time. We have a pre-fees return objective of 10% per annum. We think over the long term that's most likely to beat most equity benchmarks. In the short term, we pay virtually no regard at all to benchmarks, and it's true over the last quarter our strategy underperformed the world MSCI. We don't pay much attention. That's just an outcome. I would note over the last year, the strategy has performed above 30%, and it's performed marginally above the world equity markets, which have also been very strong over that period. Again, we don't get carried away with that 30% level. We're really saying, is that contributing towards our through the cycle 10% return objective? We've got no way of predicting what our company's share prices will do over the next 3 or 6 months. We feel pretty confident over the next 3 years, if we're right in our analysis of what those share prices are likely to do and what the business performances of those stocks are likely to do over a 3-year period or so. And we're pretty confident we know in general where we think those share prices will be going over that period. Over the next 3 or 6 months, what those share prices do over a shorter period of time, we frankly have no idea. And then how those share prices perform against an equity benchmark in the short term, we don't care, because it's really not what we're trying to do at Magellan. We're not trying to make excuses at the end of the day. It's just a fact. The strategy underperformed the world benchmark over 3 months. It certainly didn't over 12 months. And if you look on longer term periods, maybe 3 or 5 year periods, I think the returns are more than satisfactory.
And finally, Hamish, can you give us a brief update over what you've done in the fund in recent history and some of the key themes underpinning your thinking inside the fund?
Well, the strategy key themes really haven't changed that fundamentally, outside of probably one new theme we've invested in the last 12 months and probably de-weighted a major investment theme. The emerging market consumer theme that we've had for a long period of time, our investments in Yum Brands or Nestle or Coca-Cola, we've had these investments almost since inception over 6 years or so ago. They are less important in our strategy today, still important but less important. It's been driven by 2 issues. Valuations is the most fundamental issue. A lot of this area of the market has been repriced materially. We don't think we can get as attractive returns in many of those names as we would have received in the past because the share prices have gone up. And at the end of the day, we're here to make people money in where we invest. A second area, we've probably made a little bit of a lightening up in that part of the portfolio because of the tail risk around the end of quantitative easing. And if we get a very adverse scenario, we are worried about the strain it's going to put on many emerging markets and particularly emerging market currencies. So we have been lightening up some exposures very, very surgically to reduce some emerging market currency exposure in the strategy. So that's a nuanced change in the strategy, part valuation and part risk reduction. A new investment area really over the last 6 or 8 months has been out of favour large cap technology stocks. 6 or 8 months or so ago we had no investment in that area. That area is now over 10% of our portfolio. The 2 big public positions we have, and we're building a position in a third at the moment, the big public ones are Microsoft and Oracle. And again, these are out of favour large cap tech stocks. Because they're out of favour, in the very short term, their share prices may well underperform equity benchmarks. Again, we don't care about that. We care about what's going to happen in the next 3 to 5 years, and we care what's going to happen if there's a very adverse shock in the world. We think Microsoft and Oracle, because of their very out of favour status and their very high free cash flow yields, are likely to perform very well if markets are very adverse. They're not like to take off in the short term if people are getting excited by markets, But over the next 3 to 5 years, we have a view where each of their businesses are going economically. And we have a view how their share prices may play out over that 3 to 5 year view. And of course, if we've taken sizable positions, we're probably fairly optimistic. Not that their businesses are going to be magically fixed, but you're going to make a very decent return as a shareholder in those investments. And outside that, where else we're invested in the portfolio, in the payment space, we still have sizable investments in American Express, Visa Card, MasterCard, and our investment in PayPal via eBay. We are still got an investment that is skewed to the housing recovery in the United States. We have our large position in Lowe's and Wells Fargo and US Bank Corp. And of course, we've got our play on the end of QE, which is a rising interest rate story, particularly in the United States of America. And we have our investments in some large banks. I mentioned US Bank Corp and Wells Fargo. We also have investments in State Street and Bank of New York Mellon. And many of these investments have been in place for almost 12 months now. Particularly that play has been in place for almost 12 months. So that's kind of a wrap where we are in the overall portfolio.
Thanks, Hamish, and thanks for your time.
A pleasure, Mark.